Hello and welcome to this YouTube channel for HCCA FR exam prep. My name is Eden. In this video, I'll be taking you through how to account for revenue where there is a bundle of goods and services in a particular contract which have been put together before selling. So we have a product and a service where performance obligations will be satisfied over time and also at a point in time. Now let's look at the question. This is an extract from a past question. So the extract is from a trial balance which is for the year end 30th September 2014. And we have revenue, cost of sales. Now the additional information is as follows. On 1st October, so if you want to reconcile 1st October to the year end, that is a full year. So 1st October is the start of the year. Now Quincy sold one of its products for 10 million. Included in revenue in the trial balance. So it means that the 10 million is in this total revenue. As part of the sale agreement, Quincy is committed to ongoing servicing of this product until 30th September 2016, and that will be 3 years from the date of sale. Now, if you're not given this number, you should be able to count yourself to know the number of years for the servicing. Because 2014 will be the first year, 2015 second year, 2016 the third year. So you can actually verify that. The value of this service has been included in the selling price of 10. So what it means is that the servicing cost or the sales value of this servicing is in the 10 million. Now the estimated cost to Quincy of the servicing is 600 per annum. So it means that this should be multiplied by 3. And the normal gross profit margin on this type of servicing is 25%. Ignore discounting. Remember, this is cost. This is cost. So you cannot apply margin on cost. Margin should be applied on sales value. So it means that we have to change to markup. And changing this to markup would be 25 over 100 minus 25, and that should be 25 over 75. That will give you the markup, which is a profit on the cost. Now, how do we make adjustment for this sale? What it means is that by the end of the first year, they have satisfied only 1 year out of the 3 years. So you would have 2 years which will be deferred income. So what we'll have to do is to find the deferred income. So let's see. Is it a cost of the servicing? So that will be 600 times 3. That should give us 1,800. Then we add the markup. So the markup would be 25 over 75 times 1,800. Let's check that. 25 divided by 75 times 1,800. This should give us 600. Plus 1,800 will be 2,400. So we have 2,400 here. Now, the deferred income would be 2/3, which is the remaining 2 years. 2/3 of the 2,400, which is the 2.4. So here, 2,400 times 2 divided by 3, that should give us 1,600, which is I want to write it in full. That's 1.6 million. Now, what are the adjustments? The adjustment required should be that the revenue for the year have to be reduced, so we deduct the deferred income, because as per IFRS 15, revenue is recognized when performance obligations are satisfied or have been satisfied. 2 years not yet satisfied should not be revenue. So what it means is that the revenue will be, so we would have to debit revenue. So debit revenue with an amount of 1,600. So what it means is that the 213,500 we have here, the 213,500, we less 1,600 from it. That will be the adjusted revenue. Again, because it's in revenue, we have it in cost of sales. So we have to deduct from cost of sales. So we'll credit cost of sales to deduct it from it. So the cost of sales you see on the face of the trial balance, 136,800. 136,800. Again, we deduct 1,600 from it. That will give us the adjusted cost of sales. Finally, remember that the deferred income will be classified into the current liability, and that will be in the financial position statement. So because we have 2 years remaining, there is 800,000 that will be current liability, and then the remaining 800 would be non-current liability. So look at the process. Revenue is only recognized when performance obligations are satisfied, and because the remaining 2-year servicing is yet to be satisfied, it is only one out of the 3 years that will be recognized as revenue. Now, we are not looking at the product, because the product which was sold, revenue will be recognized because there was a sale. The only problem we have was that the 10 million include the 2.4 million servicing revenue, and we can only recognize 1 out of the 3 servicing revenue, and we will defer 2 out of the 3 years servicing revenue. So very straightforward. And the other technicality we had here is that we were giving gross profit margin, and we are going to apply that on cost. So if we are giving the total sales value of the servicing to be 2.4 million, then you can apply directly the 25% on it. But because we're giving cost, we have to change the margin to markup. And the only way you do that is to deduct the 25 from 100. And you remember that the margin converting to markup, we deduct. But when you are changing from markup to margin, you have to what? Increase or add. So we are changing from markup to margin, you add. So for instance, if this were markup and we have the sales value, the profit percentage will be 25 over 125. Very important. Great. I hope this helps you in your preparation for the FR exam. Please subscribe to this channel to receive latest updates on new videos.